to the special edition of The Appointment. I'm Shereen Bhan, and we're in conversation with Gunit Chadha, member of the Global Executive Committee of Deutsche Bank AG, as well as the co-CEO of the Asia-Pacific region. Gunit, it's good to have you back on the show. I remember the conversation that we were having exactly the same time last year. A lot has changed, at least in India. There's been a dramatic difference in mood. The problems that we were talking about then, whether it's current account deficit or fiscal deficit, have been contained to a significant degree. But I won't talk to you about India just yet. Let me start by talking to you about the world. We've seen the IMF and the World Bank talk about their global growth forecasts, continue to be cautious as far as global growth is concerned, have revised downwards their projections as far as global growth is concerned. What's your own take on the recovery in the US, the recovery in Europe at this point in time?
So good to be back, Shereen. I remember our conversation a year ago, and lots has changed, certainly as far as India is concerned. But let's start with the world. It's clearly been 6 weeks of great volatility having come back in the markets, right? Now, whether that started to happen because of weak German data, whether it was IMF's most sober report on world growth, they were virtually pricing in a recession in Europe with a 30% probability. I was in US at the time of the IMF meet, and I can tell you people walked in happier and walked out feeling much more concerned where the world growth will be into 2015. However, we do believe that 7 of the 10 largest countries globally will grow faster in 2015 relative to 2014. We think US will be the biggest driver of that growth. We think US grows from sub 2.5% this year to north of 3.5% into 2015.
Right.
We think India will be a big contributor, growing from 5.5% to 6.5% into next year. China, we don't believe there's a hard landing out there, even the growth comes off. Europe will struggle. Europe will grow, but it'll struggle, growing at about 1% into 2015.
So given the scenario that you've just painted, the big one, of course, that you don't expect a hard landing in China, because at this point in time, everybody's talking about the Chinese flu and how that's impacting sentiment across the world. You believe that the US is going to see a strong recovery. Europe may perhaps continue to be muted. India and other emerging markets are perhaps going to kick in. Geopolitics and the risks associated to geopolitics look a little bit less concerning as opposed to a couple of weeks ago. Then what is the big trigger as far as this global aversion, risk aversion is concerned?
I think because if you go back 6 weeks, the markets were pricing a Goldilocks scenario, right? Where every geopolitical event was really being brushed aside, whether it was the Middle East crisis, whether it was Russia, Ukraine, whether it was tension building up in South China Sea, whether it was tension in Israel-Palestine. Markets, frankly, were pricing in as if none of these could produce a significant...
So this is a bit of a reality check at this point in time?
I think it's a bit of a reality check. We do believe, as I said, if U.S. as the key driver of global growth, if U.S. grows into the 3.5% next year, our view, Deutsche Bank's view, is that global growth will move from 3.3% this year to 3.9% in 2015. So we remain constructive, though with a bias on the downside of where that growth will be as a consequence of geopolitical events which could
Okay, so geopolitics is the big downside risk that you're factoring in at this point in time.
Yeah, I think if we have to pick the top sort of 5 risks, geopolitics would be 1. China hard landing, that's not our baseline scenario. That would be 2nd. Europe recession, right? Could happen. That's not our view, but could happen as it's both structurally adjusts itself and at the same point of time seeks to grow within its boundaries rather than only have an export-led growth. And finally, a disorderly U.S. interest rate hike, but we can talk about that.
No, let's talk about the U.S. Interest rate hike, because that's exactly what I wanted to touch base with you on. What's the view at Deutsche Bank at this point in time, given the kind of economic data that we're seeing coming in from the U.S., given the commentary that's coming in from the Fed, which seems to suggest that it's unlikely to be a disorderly sort of move towards an interest rate hike at this point in time?
Well, that's what we would hope, and that's what we would expect, right? Our view is that if U.S. growth gets as strong as we think it will into the 3.5 handle, we think the rate hike will come in towards the second half of 2015. Now, we saw what a year ago the U.S. taper sort of did to emerging markets.
Right.
Now, since then, emerging markets, frankly, have strengthened their reserve positions. They've taken the right monetary policy actions. They have sort of narrowed their fiscal and their current account deficits. But still, it's an elephant out there, and it's important that that is an orderly process of rate hikes into the second half of 2015. And as a result, the vulnerability of emerging markets is more muted this time around, which is the way we think it will be.
But do you see a significant shift of fund flows into emerging markets if and when we do see the U.S. move as far as interest rates are concerned?
So, Shereen, if you go back over the since 2000, for instance, the fund flows into the emerging markets across debt and equity have been $2.5 trillion.
Yeah.
Right. And if you then look at what happened in terms of outflows, either 2008-9 or in the more recent past, it's roughly been under $1 trillion. So emerging markets still have been beneficiaries of a $1.5 trillion of fund flow from DM to EM. Will that start to reverse itself out in terms of the extent? Absolutely, certainly from some markets. We think some countries in Latin America are certainly vulnerable. Argentina, Venezuela to pick. We think India was very vulnerable.
But
right?
not so anymore?
We think the steps which the new government has taken, the reform agenda, the growing confidence, the inflows which are happening, and we can talk much more about that, the monetary policy of the central bank, we think India is now certainly not sitting in the high vulnerable. And frankly, we should be more concerned about other countries in the region like Indonesia, etc. Right?
You know, I'll talk about India specifically in just a bit, but let me talk to you about what's happening as far as other asset classes are concerned and the way that we've actually seen crude prices collapse. And it doesn't look like we are going to see a move back up in pricing anytime soon or anytime in the near future, because there is a big supply-demand mismatch at this point in time. And the view coming in from OPEC countries is that they don't intend to intervene in the market just yet. So what's the take as far as crude is concerned, and how much of a positive is that going to be for global growth, specifically for countries like India?
So it's our estimate that for every $10 a billion barrels that the crude falls, the global GDP expands by 0.4%. So it's a pretty significant impact, and especially the oil importing countries. One can't extrapolate what's happened over the last 30 days into what will happen over the next 3 years. So I think it'll be naive to suggest that crude has found its own level in terms of equilibrium in the mid-80s.
Sure.
Crude could well be back into the 90s and 100. In fact, it's Deutsche Bank's forecast that crude will head that way.
By when?
Well, we think it'll head that way into 2015. Because if we have a more constructive view of global growth and the world around,
then demand obviously is picking up.
Then you have to argue that unless shale gas becomes such an overwhelming supplier of energy,
and
not just the U.S.
That to happen.
We expect that, but transportation of gas, right, is an issue, and as a result, that takes time. So that equilibrium may not happen in 2015, and as a result, oil prices could be starting to trend up. So until then, it's a big opportunity for countries, whether it's India or many other countries in the region, Japan, China, Thailand, etc.
Let me now talk to you about India. There seems to be the thinking that post-1991, this is perhaps the first time that the government is taking a much right-of-center approach as far as economic reform and liberalization is concerned. Would you agree with that?
So very clearly, since the new government came into power with a majority, right, which is a big differentiator, I think there's been growing confidence. You saw confidence come back in global equity and fixed income investors. And so it's interesting, in 9 months of this year, India has raised over $30 billion of FI money, debt or equity. Last year did 12, right? You've seen that confidence come back in domestic savers. I mean, equity mutual funds in India have now raised in the last 5 months more than they did in the previous 5 years.
Sure.
Right?
So it's not just FI driven any longer.
Yeah, it's domestic driven as well, and frankly that's very good because India needs to get its domestic saving rate up, and it needs to make sure it funds into the financial sector. You've seen that confidence come back between Indian entrepreneurs. You've seen acquisitions happening of cash flow generating or brownfield projects. We're still some time away where new capex is getting created on greenfield projects by Indian entrepreneurs. But I think the government, through a series of steps, is making significant progress.
The Prime Minister has made the sales pitch, whether it's in the US or in India, saying we're going to remove the red tape, we're going to welcome you with a red carpet, come make in India. It's not just about made in India, but come make in India is the sales pitch. What are you hearing from boardrooms at this point in time? How infused are they? How confident are they feeling about the India story today? And do they buy what the Prime Minister is selling?
So I actually happened to spend time with many of the corporate CEOs and financial CEOs he had met in New York recently. I happened to be there around that point of time. And I have to say, there's not just growing interest, but there's a resurfacing of confidence amongst global CEOs to re-engage with India in size. It's interesting. Multinationals which are already embedded in India, whether it's in financial sector, with industrial sector, services sector, already, I think, feel very confident and are willing to put more capital to work, including Deutsche Bank. When you talk about multinationals which are sitting on the fence, they're more measured. They're certainly now deeply interested to know what's changed. They're watching what the country does, whether it's the insurance bill, whether it's the retrospective taxes. Those two capture their imagination a lot. But very clearly, I see them engaging with India deeply.